So the chances of the market testing and staying at all-time highs, that's the big question right now, because it seems that we keep getting close enough and then pulling away. So which side of the sustainability camp are you sitting on at this stage?
Alishia, to be honest, definitely not on the side of the sustainability. We don't believe that the current rally that we've seen over the last couple of days is sustainable, and really for two simple reasons. The one is that it's really been on the back of only a few stocks, mostly the large cap resources stocks, that we've seen the performance and that we're testing these long-term highs. So it's really on a very few counters, and in line with that is the advanced decline line, which we already saw peaking a month ago. 13th of January was the peak of the advanced decline line, which really just tells us that there are more stocks that are in decline than there are that are advancing. So we don't believe that the testing of these highs is really sustainable. We see a similar sort of pattern in the S&P 500, where it's also testing technical resistance, and we believe that the balance of the odds probably is towards the downside going forward.
So what strategy are you following right now? Are you buying? Are you selling? Some are saying that they're just not committing any new capital to the market. We're looking at very different companies now in terms of health compared to what we saw in 2008, the last time the market touched these highs.
Yes, I think there's still a lot of varied performance out there, and maybe that is the best strategy, that one would be taking some profits on some of the very good performances that we've seen and reinvesting some of that money into some of the laggards. I think that's the sort of thing that we see, for example, in some of our retailers today, where the likes of Truworths and Massmart are performing very, very well today. So I think that would probably be the right thing, not to take any new money to the market, but to say, let's take some profits on some of those very good performers and rather redeploy it where there might be slightly more attractive opportunities available in the market.
Of course, true, it's coming to the fore as a result of it being a credit retailer, and credit retailers hard hit during the downtime as opposed to some of the cash retailers. In the meantime, Nerina, company news out and results announcements specifically keeping everyone very busy. Absa out with numbers ahead of the market open this morning. Your overall impressions of what was released?
In terms of the headline number, the headline earnings per share number, yes, ahead of market expectations, but I think one needs to look a little bit deeper into the numbers, and you realize then that it's really just inside those numbers that you see that it's actually not such a great result. A year ago, or at the June level, we saw that the bad debt charge was running at around 150 basis points, or 1.5%. They've reduced that to 90 basis points at this stage, and that was certainly ahead of what the market expected, and that allowed them to actually declare better earnings than the market would have expected. But if you look at that sort of level of improved earnings, if you can call it earnings, really coming from a lower bad debt charge, you realize that actually on the ground, operationally, things are not that much better just yet. And if we then therefore look at things like the net interest revenue, for example, certainly still down, similar as we saw it at the June period, for example, despite the fact that financial services are looking quite a bit better. Banking was still weak, and Absa Capital has also not performed better yet. So once you start looking into the numbers, a fairly sort of flattish result from Absa Capital, nothing, or from Absa, nothing really to get excited about at this stage of the cycle.
While we're busy reconciling things here, mentions being made of this improvement in bad debts, but we're still looking at NPLs as a percentage of loans and advances at 7.7% compared to 7% last year. So really a worsening position on that end as well. To what extent is that a concern for you, the management of those levels moving forward, where we've got inflationary risks persisting and that possibly spelling higher interest rates towards the end of the year?
I think that's the very real risk that we're running there, is that currently I think most of the market is pricing in flat interest rates for the remainder of 2011. The problem is that as these inflationary pressures keep rising, that outlook might change, and I am concerned that the bad debt charges might not really be sufficient in terms of how the inflation outlook is changing. Today we saw inflation numbers coming out of both the UK and in the Euro region as well, definitely slightly ahead of expectations, and I think even in our own market, we might find that the real level of inflation is quite a bit higher than the measured numbers or the calculated numbers that we see. That obviously on the back of agricultural commodity prices to a large extent, and of course oil. We see Brent above $100 a barrel, and that certainly is affecting inflation across the world, and that is a concern for us. So when we look at the credit retailers, and when we look at the financial services companies and the banks, that's certainly a concern that we would have to take into consideration.
So there's some concern within that space. In the meantime, lots of concern in the construction industry as well. We've had WBHO out with a trading update saying that it expects headline earnings per share to be between 15 and 20% lower. And as I was saying earlier, again, illustrative of the pressure that construction companies are in at the moment.
Absolutely. I don't think it should be a surprise to anyone who's been watching the trading statements and the results of the construction sector over the last couple of weeks. Really, the construction sector finds itself in a very difficult position. They've had an incredible couple of years, really sort of buoyed by not only the World Cup, but also some significant infrastructure spend around that. And it's allowed them to expand their order books to levels quite a bit higher than they might have experienced in the previous 10 or 20 years. I think we're suffering from a little bit of a hangover in the construction sector now, where maybe investors have started getting a little bit used to these sort of size of order books, and where we are now sort of having to digest this big meal that we've had over the last year or two. There's still a little bit of indigestion going on. I don't think we're quite at the bottom of the construction cycle just yet. There's certainly good sort of outlook further down the horizon, maybe 5 to 10 years down the horizon. We are a country and a subcontinent that is still very short on infrastructure, and a lot of capital does need to be spent in that area, but I don't think it's going to come in the near term, and certainly not in the next 6 to 12 months.